welcome to Stock Talk. Okay, let's unpack this one. Today we're doing a deep dive into Centene Corporation, ticker NYSE, CNC. We're looking at an independent investment analysis from stocktelescope.com.
Yeah, and what's really striking, I think, is the timing. This analysis landed right after Centene pulled its guidance. That was July 1st, 2025.
We did the big news.
Exactly. Because of that massive $1.8 billion issue with marketplace risk adjustments, how they balance payments based on member health. It's complex, often flies under the radar for, the broader market. But it does make you ask, why on earth call it a speculative buy right now with that kind of, immediate volatility?
That's the core question, isn't it? And that's our mission today. We want to explore why this report calls Centene a contrarian value opportunity with significant risk. They're actually aiming for a target of $45 to $55 within, 12, 18 months?
That's the range, yeah.
So we need to dig into the investment thinking behind that call, especially given, the stock's current problems and these historically low levels it's hitting. Just looking at the numbers now, Centene's trading around, $33.78?
Roughly, yeah.
That's down nearly 50% over the last year. It's pushed the PE ratio down to, just 5.03x.
Incredible.
For a Fortune 25 company, pulling in over $153 billion in revenue. That kind of valuation.
Yeah.
Usually see that for companies maybe, on their way out.
It feels like terminal decline territory, doesn't it? And the market's reaction, especially to that $1.8 billion risk adjustment, which, hacks about $2.75 off estimated EPS, it just screams peak negativity, peak pessimism.
Okay.
And, stepping back, that's where the report argues the value opportunity lies. This reaction, it looks like what value guys call a fear discount.
Right.
Pushing the stock not just to those historic lows, but actually below tangible book value.
A low tangible book.
Yeah. For a lot of investors, that suggests the actual assets, the stuff you can touch, might be worth more than the whole company's market cap right now. It really sets the stage for maybe, significant multiple expansion and it's a big if, those operational problems are fixable.
And it's not just about the cheap price tag, right? The report highlights Centene's market position.
Absolutely.
They are the biggest Medicaid managed care player in the U.S., serving over 27 million members, mostly in these government-sponsored programs. Think about that scale. Medicaid managed care spending was, over $500 billion last year? And still growing, plus it's defensive. Enrollment tends to go up when the economy goes down, countercyclical.
That's a critical point. It underscores a core part of the argument in the report. Specializing in government programs, maybe unlike some bigger, more diversified competitors, gives them potentially deeper expertise, stronger state relationships.
Right.
Plus, the report points to, favorable long-term trends, continued Medicaid expansion, the aging population, the shift towards value-based care, all potentially tailwinds.
Okay, so we've painted the potential upside picture. But like you said, it's speculative. High reward means high risk. What are the specific dragons here the report calls out, beyond just that initial billion-dollar hit?
Exactly. The report is very clear. This is speculative. Fundamentally, that $1.8 billion issue points to, a serious miscalculation of member morbidity trends.
Meaning they misjudged how sick their members were or would become?
Precisely. They got the anticipated costs wrong, leading to these unexpected claims. For an insurance company, that's a fundamental error. It definitely puts a question mark over their actuarial capabilities, their ability to predict costs.
That's serious.
It is. The whole bull case really hinges on two things. Valuation normalizing from these extreme lows, getting back to maybe a 10-12x PE, and a major operational recovery, especially with medical cost inflation rising generally. That adds another layer of pressure.
Okay, so wrapping this up, what does this all mean for you, our listener? Centene looks like a classic high-risk, high-reward contrarian idea. You've got it trading at that super low PE, 5.03x, but it's still a market leader in these defensive government healthcare programs.
Yeah, if you zoom out, the whole investment thesis depends heavily on getting that valuation back up and fixing the operational side, managing that huge risk adjustment issue, handling rising medical costs. It is, without a doubt, speculative. It really highlights, I think, how crucial it is to weigh potential rewards against very real, very immediate risks, especially in a market that's, changing so fast.
Absolutely. It leaves you with a thought, doesn't it? In volatile markets like this, how do you personally weigh that kind of maximum pessimism, that potential rock-bottom entry point against significant, maybe even unquantified risks? Something to chew on. And remember, this deep dive is strictly for educational and informational purposes. It is not investment advice. Always do your own homework, your own due diligence, and please consult with licensed financial advisors before making any investment decisions. All investments carry risk, and that includes the potential for total loss of capital.